Morning, everybody. In the last two parts, you had looked at how to derive the sales revenue and the inventory purchases through preparing the control accounts for trade receivables and trade payables. In this part, you will be looking at how to derive the cost of sales, and it will be looking at the previous information that you have gotten from the control accounts as well as preparing the inventory account. All right. So cost of sales. What is the cost of sales? Basically, the cost of sales is the cost price of inventory that was sold, right? So cost price of inventory that was sold during this period. So in order to understand which account you need to prepare to find out what is the cost of sales number, you will need to look at the journal entries that's involving cost of sales. So when there's a cost of sales, what is the double entry that is involved? Basically, you have to debit cost of sales, which means you have to increase cost of sales, and you have to credit inventory, which means you have to minus away the inventory. Therefore, by preparing the inventory account, if you're going to prepare the inventory account, you will be able to derive, or you will be able to find out the number of cost of sales. You will be able to find out the cost of sales value. So let's take a look at the next example, example 3. Now I have to emphasize again, example 1, example 2, example 3, they are all linked together. So later on, I will be looking at example 1 and example 2 to get some numbers from there. Alright, so you got the same company, Jollibee Trading. So Jollibee Trading had the following inventory balances. On the first day of the year, of the period, the beginning balance, there was a 1st of January 2000X3, there was a beginning balance of $24,335. On the last day of the year, which is the ending balance, there is an ending balance amount of 27,836 inventory balance. So what we are going to do is that we will need to use the earlier examples, example 1 and example 2, because from earlier example 1 and example 2, we can find out all these numbers. We can get the cash purchases, we can get the credit purchase number, and we can get the purchase returns number. All right. So very similar to sales revenue and inventory purchases, you are going to prepare the inventory ledger. Why? Because you need to find out what is the cost of sales account value. All right. So what you're going to do now is you are going to prepare the inventory account. You will need to use the cash purchases, credit purchases, and purchase returns, all from example 2. And you're going to prepare the inventory account. Alright, but before you use all these numbers, what do you start off with first? What do you think is the first thing that you start off with? Dun, 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 dun. You're right. You actually start with the beginning balance, 24,335. So you're going to start with the beginning balance first. Alright, so this is how we start our beginning balance. 1st of Jan 2000X3, the balance brought down is 24,335. Alright, so now that you have your beginning balance, we are going to record our cash purchases. Alright, so cash purchases means you purchase inventory using cash. And if you purchase inventory using cash, usually you will record it as a cash at bank or for cash purchases. And you buy inventory, right? So if you buy inventory, it will be a debit or a plus column. What is the number that you're going to write here? Actually, cash purchases was in example 2. So you need to flip backwards to example 2 and take a look at example 2. What is the cash purchase? So here we are at example 2, and we actually have it here. Cash purchase is $3,500. All right, inventory increase, cash in hand increase. Okay, so go back again. Inventory increase, and cash in hand increase. Alright, so inventory increase, debit 33500. The other account affected is cash in hand for cash purchases. So after that, of course, we will have to calculate our balance number. Alright, so 24,335 debit, you're going to debit it again, so it becomes 27,835 debit. Okay? Alright, now that you have your cash purchases, what other things cause your inventory to increase? Another thing that causes your inventory to increase is your credit purchases, when you buy things on credit. And when you buy things on credit, the double entry is inventory increase, and then the other account is trade payables. So this is your credit purchases, alright? Okay, so where do you get your credit purchases number? You get your credit purchase number from what you calculated above just now. So I'm going to scroll up again. Scroll. There you go. Can you see this portion here? Where you calculated your credit purchases and you found that your credit purchases is 16,400. So you are going to use 16,400 and substitute that into your inventory ledger. So let's take a look at our ledger again. 16,400 will be inside the debit column, because when you buy inventory on debit or on credit, you increase inventory. The other account affected is trade payables. And of course, you are going to calculate your balance column. 27,835 debit plus 16,400, you get 44,235 debit. The last item. Now, when you buy inventory, right, sometimes your inventory is spoiled. So you need to return your inventory, right? So when you return inventory, right, what are the double entry? You record inventory minus. Okay, you record inventory minus, and you record trade payables. Now, trade payables is I will write purchase return behind. Alright, you can see that I actually put some bracket. It's not compulsory, but I like to do it so that I know why this entry is here. If not, I get confused. Okay, so inventory reduced because there was a purchase return, and the other account affected is trade payables. Now, where am I going to get this purchase return number? It's actually from the previous question. So I go to the previous question again, and I see, oh, is there a return of inventory? Is there a return of inventory? Yes, actually, there's a return of inventory, like what I'm going to highlight in this psychedelic turquoise. All right, there was a purchase return of inventory to credit suppliers of 1,007. I would have recorded inventory minus. Can you see here? Inventory minus trade payable minus. So I'm going to record this 1,007 inventory minus the other account is trade payable. All right, so inventory minus. And of course, I'm going to calculate my final balance, deducting away that 1,007, which will give me 42,535. And then finally, I have nothing else left. I've recorded most of what I need for inventory: cash purchase, credit purchase, and purchase returns. Now, one last thing that I need to record for inventory, okay, is this cost of sales, all right? So cost of sales will cause inventory to go down, all right? And of course, I need to record my ending balance, right? So what I'm going to do now is I'm going to leave a line for my cost of sales, and I'm going to record my ending balance first on 1st of July. So what is the ending balance value? 27,836. So I will record balance brought down in the balance column, 27,836. So the question is, how did 42,535 dropped so much and only become 26,836? Why was there a $2,000 over drop? There was a $2,000 over drop because of cost of sales. Now, what happened here is that the company sold these goods and these goods were converted into cost of sales. All right, and cost of sales will cause your inventory to go down, not 20,000, but 14,669. So this cost of sales, you need to calculate it yourself. All right, so how did I calculate this cost of sales? All I did was to take 42,535 minus away 27,836 and I got 14,699, and this is my cost of sales. All right, so for cost of sales, there's no credit or cash transaction. You only need to prepare the inventory account. But what is difficult is that you see these three numbers that I highlighted, you actually need to get it from your inventory purchases question. All right, that's the main difference. Okay, so this is the first method where you need to calculate your cost of sales by preparing an inventory account. As usual, if you don't want to prepare inventory account, also can. I never force you. The second method is for you to calculate cost of sales without preparing any inventory account. So you need to recall your inventory account, this inventory account. All right. So again, your objective is to calculate the ending balance. All right, so if your objective is to calculate the ending balance, you start off with ending balance first. And then after that, the first item is actually your current year balance brought down, right? So we do the same thing. Current year balance brought down. Current year balance brought down, you start with that. You minus away cost of sales. Why minus away cost of sales? Because cost of sales is the one that when you have a cost of sales, it will reduce your inventory amount. Okay, so you minus away cost of sales, and this cost of sales is actually your unknown. After that, what do? You increase your cash purchases. All right, so you increase your cash purchases, and then you increase your credit purchases. Here, you increase your credit purchases, right? So you increase credit purchase plus. And finally, you record inventory minus. Minus why? Because there was a purchase return. So inventory minus because there was a purchase return. Anything else? No, you recorded all in already. Right, so if you substitute all the numbers in, this is the first working, you put all the numbers in, where this number, the last three numbers, right? The last three numbers actually came from the previous example. All right, so you substitute all the numbers in, then you try to make, you simplify it a little bit, and then now you try to make the cost of sales the subject of your number equation. And there you have it. You have method 2 where you calculated the cost of sales without preparing your inventory account. Hang in there, people. This is the last small part. See you later in the last and final part where you prepare trading account. See you.